Welcome to today's hearing of the Senate Banking Subcommittee on Financial Institutions and Consumer Protection. Today's hearing is in a hybrid format, but our members and our witnesses are all here in person. We're grateful for their presence and your willingness to participate. Today, this subcommittee will examine the consumer protection risks and harms of private student loans, including the roles of lenders, both banks and non-banks that are operating in this space. We will also examine ongoing challenges that millions of Americans are still experiencing with their student loan servicer. Today's hearing will be the first time in a decade that the Senate Banking Committee has focused on private student loans, a growing and opaque financing option that students are using to help pay for the rising cost of college. Collective student debt continues to rise, with the Federal Reserve finding Americans collectively owe more than $1.74 trillion in debt to the Federal Education Department or to private lenders, $1.74 trillion. This number has risen every year except for 2023, and of that total, $133 billion is owed to private lenders in the form of private student loans, including more than $5.6 billion in the state of Georgia. The Biden-Harris administration has recognized the weight that an excessive student loan burden can have on Americans. And to date, the Biden-Harris administration has announced nearly $170 billion in relief for almost 5 million borrowers. However, these are only federally backed student loans. And borrowers continue to report issues with their private loans. While we are not expecting the CFPB's Educational Loan Ombudsman's annual report until next month, information we already have shows that the CFPB received more than 15,000 complaints from September 1st, 2023 to August 30th, 2024, related to private student loans and federal student loan servicing. My staff and I have analyzed some of these complaints from borrowers, and when looking through the complaints, you're struck by the sheer scope and magnitude of the problem. Private lenders and servicers routinely misled or deceived borrowers, and the stories are frustrating and heartbreaking. Confusing processes, poor customer service, and just a genuine failure of many lenders and servicers to work with struggling borrowers. With numbers that high, it's easy to forget that there is an entire life and a story behind each of these complaints. These are real people with families, and these are real consequences. I'll share just one example from a borrower in Atlanta, Georgia, who holds private student loans. This person had attended a for-profit college that has been found guilty of misleading students about the employment and the earning rates of their graduates. Because of this fraud, the individual's loans should have been eligible to be discharged. However, their lender denied their discharge. Think about that. This person was the victim of lies on the front end of the process. They had already selected a school based on untruths about that institution, and then they were deceived into enrolling and taking out a loan based upon a false premise. Not only did their lender refuse to cancel their fraudulent loans, which the law requires, they then refused to share information on how to file an appeal or respond in any way to this Georgian in need. Real people, real problems, real consequences. And so I also submit this packet of horror stories from borrowers with private loans collected by the project for predatory student lending for the record. And without objection, this is so ordered. There were more than $10 billion in private education loan originations last year, an increase from $6 billion in 2011. Private student loans are currently estimated to be more than 7% of the total student loan market. And although private student loans represent a relatively small portion of the student debt landscape, borrowers seem to have more and more issues with them. Taking data from October 2022 through September 2023, the CFPB Student Loan Ombudsman Report found 1 in 4 complaints filed to the CFPB about student loan issues was from borrowers with a private student loan. So think about that. Only 7% of student loan volume are private student loans, but those private student loans make up 25% of loan complaints. That indicates a serious consumer protection problem in private student lending. Today's hearing will also touch on some of the ongoing challenges with student loan servicers. Generally, private companies that collect payments from and provide customer service for both federal and private student loan borrowers, and it could not come at a more timely moment. Just last week, the CFPB announced Navient, a giant student loan servicer, would be banned from servicing federal student loans again and forced to repay $100 million to borrowers the company harmed. Navient also must pay a $20 million penalty. While this settlement still must be finalized by the court, it sends a strong message to other servicers that they cannot profit from harming student borrowers. In April, my colleague, Senator Elizabeth Warren, held a hearing highlighting harmful practices by the student loan servicer, Mohila. This hearing highlighted a decades-long pattern of mismanagement and misconduct that harmed millions of borrowers nationwide. Because of institutional failures of servicers like Navient and Mohila, borrowers faced real-world consequences, including paying more than they should have, not being directed toward loan forgiveness programs, or even having their accounts mismanaged to the point that their credit scores lowered, making it harder for them to buy a home and build wealth. I believe that when we center the people, we make better public policy. So as we approach today's hearing, I think it's important for us to center the experiences of student loan borrowers and bring ourselves back to when we were looking at different colleges. I remember that experience, and trying to make likely the biggest financial decision of our lives up to that point. This is a real issue for all students, but as a first-generation college graduate myself, I know what it's like to face that, face those questions. The process is complex and often, these days, deliberately opaque. Many non-traditional students have to navigate this financial maze without the help or support of a parent, and they may in some cases be busy parents themselves. These are massive financial decisions, the equivalent of a mortgage, and sometimes a risky bet on their futures with massive consequences that may follow them for decades. We owe it to students to ensure that those bets pay off, and that the game isn't rigged against them by predatory, unfair, deceptive, or even abusive behavior from private student loan lenders and student loan servicers. We owe students who are just trying to get ahead, trying to be productive citizens better. I hope today's hearing helps improve transparency around student lending and that it brings accountability for the private lenders and student loan servicers that have too often misled and harmed borrowers. Indirectly, they harm us all. Thank you, and I will now turn to my colleague, Senator Lummis, for her opening statement.
Thank you, Mr. Chairman. I'm sitting in for Senator Tillis, who was called away in a family emergency, and so thank you for tolerating my presence as your sidekick today. And thank you, witnesses, for being here. You know, when I came to Congress initially in the U.S. House in 2009, there was an entity in Wyoming called the Wyoming Student Loan Corporation. And it was extremely successful in servicing student loans, in helping keep their delinquency rate around 5% and their failure to pay rate down around 2%. It was incredible. And it was because they'd catch students when they just were starting to miss payments or pay partially, and they would work with them to help them budget and keep on track with their student loans. The Wyoming Student Loan Corporation was dissolved as part of Obamacare, because during Obamacare, that's when the current student loan situation was pretty much taken over by the federal government. So Wyoming's Student Loan Corporation was dissolved, its employees went away, and the federal program has not been as successful as Wyoming Student Loan Corporation was. So we're back in a point where Wyoming has done a better job. The federal government's doing a dismal job, and now we're picking up the pieces. We're meeting today to examine the student loan market, particularly the markets and servicers for private loans. But I want to add some important context for this hearing. Based on the prepared testimony of two of the witnesses here today, Professor Jimenez and Ms. Canchula Bañez, you may use this hearing to voice support for universal free higher education. And you're well within your rights to do so. I respect you for being forthcoming with your beliefs. But I want to stress that I really oppose this point of view. The student loan system and our education system more broadly is already plagued by many issues. Universal free higher education would accelerate these chronic problems. Take, for instance, the Biden-Harris administration student loan executive actions. The Biden-Harris administration has used executive actions to invent legally dubious student loan forgiveness, modify income-driven repayment plans, extend and re-extend a 41-month-long repayment pause during COVID, and other debt relief measures. Combined, the Biden-Harris administration has cost the U.S. taxpayer $870 billion to $1.4 trillion in higher education expenses. In just 4 years, Biden has exceeded the $744 billion the federal government spent over the cumulative span on higher education from 1962 to 2019. In other words, from when I was 8 years old until the present, all the money that was spent in that period of time was spent by the Biden administration in just 4 years. That's lighting money on fire. Turning to the focal point of this hearing more directly, the conversation around private student lending misdirects attention from the more significant structural issues within our student loan system, the government system. These issues include rising tuition costs and the shortcomings of federal student loan programs. From the outset, it's critical to note that the private student loan market accounts for only 8% of outstanding loans, and a supermajority of loans are federal loans. Additionally, many of the laws and regulations in place to safeguard consumers against financial harm, including the Truth in Lending Act, provisions against unfair, deceptive, or abusive acts or practices, and many others, not only apply to the federal loan market, or rather the private loan market, but exceed the requirements on federal student loans. Any assertion that the private loan market writ large is some sort of Wild West out there without rules and safeguards is simply untrue. While individual cases of malfeasance certainly exist in the private loan market, as they do in any market, private lenders fill a crucial gap in higher education financing and equip borrowers with the tools to meet the barriers to education in place today. Demonizing private lending ignores the reality that loan servicers offer tailored solutions for borrowers when federal programs fall short. Put simply, private loan lenders provide more information about their products to borrowers, offer loans with greater constraints and risk-based metrics, and deter overborrowing to a much greater degree than federal public loans. The Biden administration's politically motivated and legally dubious student loan forgiveness schemes have complicated the student loan landscape, increasing confusion and failing to address the root causes of skyrocketing tuition. Loan servicers have had the rules of the programs and the terms of their contracts rewritten and rewritten again by the Biden administration month after month. No organization could effectively operate in such a climate. Instead of focusing on private lenders, Congress should look to improving student financial literacy, simplifying financial aid offers, and promoting transparency around student outcomes. That's why I worked with Senator Barrasso to introduce the Transparency in Student Lending Act, which would require institutions of higher education to disclose annual percentage rates, standard terms, and fees on federal loans to borrowers before disbursements. The federal student loan system is unsustainable, and without meaningful reform, these political piecemeal executive actions will continue to exacerbate the problem, not resolve it. Private lending is not the root cause of the student debt crisis, but a market-demanded supplement. Mr. Chairman, thank you. I look forward to questioning the witnesses about this important topic, and I yield back to you.
Thank you very much, Senator Lummis, for your opening statement. Now let us turn to our witnesses. Testifying today will be Asa Canchola Banez, the Policy Director from the Student Borrower Protection Center. Next, I want to welcome Dr. Beth Akers, a Senior Fellow at the American Enterprise Institute. And finally, our third witness is Professor Dalia. Professor Dalia Jimenez, Professor of Law at UC Irvine School of Law, Director of its Student Loan Law Initiative, and co-principal investigator at the Debt Collection Lab and the Financial Distress Research Project. We appreciate your testimony, and I look forward to our discussion. Ms. Banez, I will turn first to you.
Thank you very much, Chairman Warnock, Ranking Member Lummis, members of the committee. Thank you for the opportunity to testify today. My name is Aisa Canchola Banez, and I am the Policy Director for the Student Borrower Protection Center. Our mission is to alleviate the burden of student debt for millions of borrowers across the nation. It's an honor to take part in this hearing today, the first in more than a decade, solely focused on the harms of the private student loan market. Combating the student debt crisis is a critical racial and economic justice issue. Originally created as a tool for social and economic mobility, student loans were supposed to grant all families, regardless of race and economic status, the chance to unlock the promise of a higher education. But for too many, student debt has become a life sentence, holding borrowers back from buying a home, starting a small business, and even starting or growing a family. Yet the national headlines have overlooked the smaller, yet growing levels of private student lending and the companies that profiteer off of keeping families and students in debt. It's estimated that Americans owe more than $134 billion in outstanding private student loan debt. While this amounts to roughly 8% of the total student loan market, it's now larger than the payday loan market and the balance of all outstanding past due medical debt. While other consumer finance markets like mortgage and credit cards have robust data transparency, the absence of comprehensive data in the private student loan space has too often left borrowers, policymakers, and advocates in the dark. This has allowed for significant gaps in protections for the millions of Americans forced to take on private student loan debt, and has made it harder for policymakers and law enforcement officials to protect borrowers. Lobbyists push claims that private student loan repayment rates and borrower outcomes are largely positive, failing to capture the lived experiences of borrowers, especially those from historically disenfranchised communities. For example, Research has found that nearly half of Black private student loan borrowers with bachelor's degrees reported falling behind on a student loan payment, a rate 10 times higher than their white peers. Students attending for-profit schools are more likely to rely on private student loans, more likely to face poor labor market outcomes, and more likely to struggle in repayment. And CFPB complaints show that older consumers, who now make up the fastest growing segments of private student loan borrowers, are showing signs of higher rates of distress compared to their younger borrowers. When private student loan borrowers fall behind, they are left at the mercy of their lenders and struggle to access relief and justice. During the COVID-19 pandemic, private student loan borrowers were excluded from federal relief and left to fend for themselves. And this is due to the lack of comprehensive consumer protections for private student loan borrowers. These borrowers have limited options to modify their payments during periods of distress, and cosigners struggle to access promised release even after years of repayment. They also face challenges accessing relief from their lenders after being defrauded by their school and even after successfully having their loans discharged in bankruptcy. CFPB complaints further affirm these ongoing challenges that borrowers face. Last year, a quarter of all student loan complaints related to private student loans. But unfortunately, this is only the tip of the iceberg. In recent years, we've seen a growing and lightly regulated market of so-called shadow student debt. These products have proliferated, seeking to capitalize on students and families struggling to cover the skyrocketing costs of college. Shadow student debt consists of personal loans, lines of credit, buy now, pay later debt, income share agreements, institutional debts owed directly to schools, and several other financial products tied to education and workforce training. Many of these products stem from the desire by policymakers and schools to embrace innovative ways to help students and families pay for college. But a series of investigations and lawsuits reveal that this debt and credit exposes borrowers to high fees, harsh contract terms, and abusive collection tactics that empower profiteers and push families further into debt. It is long past time to shed light on the risks and harms of this market and rein in the abusive practices that have been allowed to go on for far too long. For families crushed by student debt, the stakes could not be higher. Proposals like the right-wing Project 2025 seek to keep borrowers drowning in debt. But don't take my word for it. Take theirs. Page 285 calls for the elimination of the Department of Education. Page 354 calls for making it even harder for defrauded borrowers to have their loans discharged. Page 361 calls for the elimination of the Public Service Loan Forgiveness Program and income-driven repayment cancellation after 20 years. And page 353 calls for the complete privatization of student lending programs. These policies will wreak havoc on borrowers, throw more Americans into the private market, and lock our most vulnerable students out of higher education altogether. Thank you.
Thank you, Ms. Banez. Next, we will hear from Dr. Akers, Dr. Beth Akers.
Good afternoon, Chairman Warnock, Senator Lummis, and distinguished subcommittee members. Thank you for the opportunity to testify today on the issues and concerns facing private student loans and servicers, as well as the state of federal student lending. At present, there are more than $1.74 trillion in student loans outstanding in the U.S. economy. This is a massive amount of money that represents serious liabilities for millions of borrowers across the United States who are grappling with the process of repayment. This massive amount of outstanding debt also represents a tremendous liability to taxpayers. This is the result of President Biden's efforts to cancel student loans, which, if allowed to be implemented, will transfer that enormous liability away from borrowers who took on the debt and onto taxpayers, many of whom never enrolled in college. In contrast, private student loans make up just a small share of that outstanding debt. At present, $133 billion of that total amount were borrowed from private lenders. The federal student loan program and the associated portfolio of outstanding loans are in complete disrepair due to efforts from the Biden administration to cancel student loans despite no legal pathway to do so. But the private student loan industry is a well-functioning consumer credit market. Borrowers with private student loans are largely successful in repaying their debts. Recent reports from industry suggest that the vast majority of borrowers are in good standing on their loans, and as we all know, repayment rates on federal student loans are poor. A loan program that fails to collect the debt it issues should hardly be considered a loan program. Instead, the federal loan program is functioning as a convoluted and opaque system of subsidies that encourage inflationary pricing from institutions and discourages thrift among borrowers. Private student loan origination and servicing, both for federal and private loans, hasn't been perfect. Lending institutions and those that service loans are fallible, but private entities supporting student lending in any capacity don't deserve the ire of lawmakers looking for a quick fix or even a scapegoat for what is happening more broadly in student lending. In fact, there are many ways in which the private loan market could offer a model for how the federal loan program could be reformed to operate more effectively and efficiently. The private student loan market is highly regulated, as it should be. Young people who use student loans at high rates can be naive to the trade-offs involved in different financial instruments, so it's imperative that lenders comply with high standards when it comes to consumer education and disclosure requirements. Private lenders are currently held to standards that exceed the disclosure requirements that are mandated in the federal lending program. This likely contributes to the success in repayment seen among private student loans. That said, there is room for improvement. For example, we should reconsider the treatment of private student loans in bankruptcy. Student loans are somewhat remote from eligibility for discharge during bankruptcy. Discharge of student loans does happen during some bankruptcy proceedings, but the standards for eligibility are opaque and too strict. I anticipate that the tone of the hearing today will reflect a general skepticism about private sector participation in student lending. There seems to be a persistent sense among left-leaning observers that profit-seeking has no place in education at any level. In contrast, I believe that growing the role of the private sector could offer a solution to many of the challenges we are currently facing and have written as much, particularly in the arena of graduate student lending in a recent report. Servicers of federal student loans are often villainized by those concerned with the plight of borrowers holding federal student debt. But the actions taken in recent years by the Biden administration have taken a difficult job and made it practically impossible. Like all of us, servicers and federal student loans and federal student lenders make mistakes, some more than others. But if our goal is to put in place a lending program that is likely to succeed administratively, then the steps taken to complicate and manipulate the lending program, often on short notice, are definitely steps in the wrong direction. I am deeply concerned on behalf of taxpayers about the exorbitant expense of these recent interventions, and concerned on behalf of Americans about the lawless nature in which the administration is attempting to enact them. But I am mostly deeply concerned about the trajectory for higher education in the U.S. The way that the Biden administration has intervened in the marketplace for higher education has effectively deteriorated any incentives that college and universities previously had to charge prices that are in line with the value that they provide. Likewise, students who were previously incented only to borrow what they needed and expect to repay would be wise to exploit the taxpayer-funded subsidies that are unfortunately now free for the taking. I'm grateful that the subcommittee has taken the time to delve into these issues facing higher education and look forward to future action taken by members of this committee to pass legislation that would rectify the challenges we face. I thank you again for the opportunity to be here today and share my testimony, and I look forward to your questions.
Thank you. Next, we will hear from Professor Jimenez.
Chairman Warnock, Senator Lummis, and members of the subcommittee, thank you for the opportunity to speak to you today. My name is Dalia Jimenez. I'm a professor at the University of California, Irvine School of Law, where I co-lead the UC Student Loan Law Initiative. Over the last decade, the private student loan industry has transformed. After declining during the financial crisis, the industry is back and reinventing itself in ways that demand our close attention. New financial products have emerged, offering alternatives to traditional loans, but they come with added risks that we're only beginning to understand. Many are offered by schools that provide dubious value in return for costly credit. One concerning practice is the explosion of tuition payment plans, often marketed on school websites as, quote, not a loan, and promising, quote, no debt. This is misleading. These plans include enrollment fees, late fees, and other charges. Some avoid truth in lending disclosures by structuring themselves as short-term credit, while others simply disregard the law. Students wishing to avoid debt may choose these plans over federal loans, not realizing they are sacrificing important protections and still incurring a debt. In some cases, they may be automatically enrolled if their financial aid is delayed. In 2022, we found students at California public institutions were saddled with almost $400 million in institutional debts in just the first 2 years of the pandemic. When students can't repay these debts, the consequences escalate quickly. Institutions impose interest, prevent re-enrollment, or withhold transcripts, hindering students from continuing their education or securing employment. These punitive actions are not just wrong, they're sometimes illegal. For example, despite laws banning transcript withholding due to debt, many schools continue this practice, even stating on their websites that they withhold transcripts today. I also want to highlight the rise of shadow student debt, typically associated with vocational programs and boot camps. We're seeing an explosion of schools promising to, quote, change your life in a few months. Students are urged to finance these programs by pledging a share of their future earnings, as high as 14% of their pre-tax income for several years. Despite CFPB action against some of these income share providers, new ones continue to emerge. These programs disproportionately target women, minorities, and those who started but did not complete college, groups that already face significant barriers to economic advancement. In my last few minutes, I want to highlight how abuses in our legal system exacerbate the challenges faced by student borrowers. Since 2005, private lenders have enjoyed special protection, making their loans difficult to discharge in bankruptcy, causing confusion because not all student debt is entitled to this treatment. Lenders may exploit this confusion by settling already discharged claims and forcing borrowers to waive future rights, as I have found in my research. Congress should treat student loans like other consumer debts, making them dischargeable when a bankruptcy judge has ordered it. Struggling borrowers often face state court lawsuits. Even when debt collectors fail to comply with legal requirements, judges grant them judgments, often adding high fees and interest. These abuses of the legal system compound borrowers' financial hardships and trap them in cycles of debt. It's crucial that we proactively address potential risks to consumers with private student loans. I urge the CFPB to take a more hands-on approach in this market. Specifically, they should create a registry of financial services firms involved in private student lending. We don't know enough. This would include the traditional lenders that we're familiar with, as well as new entrants, like I've been talking about. And they should issue market monitoring orders to the largest providers of both traditional and shadow student debt to gather information. By these actions and others I outline in my written testimony, we can better understand the risks and protect students and their families from unfair, deceptive, or abusive practices. Private student loans can be a stopgap, but they're not a sustainable solution if what we care about is equitable access to education. If what we want is everyone who wants an education, who wants to improve their lives, has an opportunity to do so, regardless of their background, regardless of how they were born, regardless of their wealth, their credit score, or the wealth of their family, or the color of their skin. If that's what we want, if we want an educated populace, we have to invest in education directly, not through loans, not by putting the risk on students to pick a program to improve their lot in life when the labor market may be stacked against them. We must directly invest in education. We have to address the entrenched disparities affecting marginalized communities. Thank you for your time and attention, and I welcome your questions.
Thank you, Professor Jimenez. Now we're going to go to questions, and Senator Lummis is going to start.
Thank you, Madam Chairman, and I understand that Ms. Jimenez was one of your students when you were teaching, and it's always lovely to have those relationships reestablished here in Washington, so congratulations to both of you. Dr. Akers, private student loans account for only about 8% of the outstanding student loan payments. So how can they be the primary cause of the student debt crisis?
In fact, I don't think they're the primary cause of the student loan crisis.
So should we be focusing instead on flaws in the federal loan programs and tuition costs?
I think there's plenty that we could be talking about that are issues in the federal student loan program that would go a lot farther in helping more Americans who are in fact truly struggling today. So I do believe that the focus today is misguided in talking about the private student loan market.
Okay, so name the top two as you see it in terms of issues you think are more dispositive.
My core concern at this point is the trajectory of higher education pricing and borrowing based on the recent interventions. That is, we have made it so that people can borrow without responsibility of repaying, which means that as institutions, there's no responsibility to charge prices that are in line with value, and there's no responsibility for borrowers to borrow loans that they anticipate repaying. This puts us on a real downward spiral, and we have major interventions that will be necessary to undo the damage that's been done.
What do you think would be the benefits of looking at improving financial aid transparency?
I think it's a fantastic step. It's a piece of a broader puzzle. We know that when people are enrolling in college, they have relatively little information about the decisions that they're making, and yet they're signing on the dotted line anyway. Some of that is because we've made a culture of celebrating college as this golden ticket to financial prosperity that I think has done a disservice. So we need to encourage people to be more skeptical about the degrees that they're paying for, and also put in front of them the information that would help them understand whether or not they're making a strong investment in their future.
Do you think we should scale back federal lending programs?
I have major concerns about the essentially limitless nature of borrowing in the graduate student loan program. So if I were to be given the ability to make changes myself, that's where I would start, in scaling back the amount of debt that's available to graduate students.
How can we, and you alluded to this in response to my last question, ideas for promoting accountability among colleges to prevent these runaway tuition costs?
So right now we have colleges who have continued access to federal student aid. That's Pell Grants, that's access to loan dollars, who are continually putting students out into the world after their enrollment without the ability or really the preparation to earn an income that would make their loans affordable to repay. We need to hold colleges to a higher standard. My feeling is that the federal government needs to look at the earnings outcomes, the employment outcomes at institutions, at programs of study, and demand that institutions who are not producing results for their students no longer have access to those federal student aid programs. So essentially cutting off federal dollars to institutions that are not serving students.
Okay, turning back to the student and perhaps their families, parents or other responsible people, working together, how can Congress work to help ensure that students and families are making informed, responsible decisions about how much debt they can carry and whether the career path they're considering is going to help them pay back that loan eventually?
There was a big step forward during the Obama administration on transparency around data and student outcomes. I think we need to eliminate the restriction on the unit record data system that would allow us to have even better data to tell how previous students at different institutions and programs of study have fared. And so I can certainly imagine a bipartisan path forward that would be lifting that restriction and making transparency better for students and their families.
Yeah, one of the really difficult things in the ranching business that I grew up in is students that go to veterinary schools the tuition's really high. And if you go into small animal, your dogs and cats and other small animals, in an urban area, you're probably going to get good return and be able to pay back your loan. If you're doing large animals in rural America, you're not. You're not going to make very much money. And so I do think it's important that there be mechanisms when federal dollars are involved to help advise people that there are certain career paths that are just not going to pay in a way that allows one to have a decent lifestyle and still pay their student loans. The other thing that's going to be interesting as we go forward is the effects of artificial intelligence, because we know now that AI is going to have a greater effect on white-collar jobs than on blue-collar jobs. And in a good way, the assistance that's going to come from artificial intelligence to help people read diagnostics in healthcare is going to transform the ability of physicians and healthcare providers to make critical diagnoses. Whereas the blue-collar worker who's actually repairing that diagnostic machine is always going to be needed. And so those are the kind of things we probably also need to be looking at going forward. I do want to thank the witnesses so much for being here. And once again, congratulations, student Jimenez. Your professor is very proud of you. I yield back, Madam Chairman.
Oh, thank you very much. Thank you, Senator. So for nearly a decade, I've led investigation after investigation into student loan servicer Navient for its appalling mistreatment of borrowers. In 2015, I called on the Department of Education to crack down on Navient for cheating military families. In 2017, I raised the alarm about Navient's $155 million expansion into the private student loan market. In 2019, I urged the department to fire Navient, and those are just the highlights. Oh, and in 2021, in the first banking subcommittee hearing that I chaired, I questioned Navient's CEO about the servicer's failed record. Later that year, Navient finally left the federal student loan system, and I was proud to help deliver that long overdue win for borrowers. But that was not the end of the road. Ms. Canchola-Banez, you're an expert on the student loan system. After Navient exited the federal student loan system, were borrowers free from misconduct?
Unfortunately, no, Senator. And you're right. The ending of Navient's federal contract was a huge win for borrowers and would not have been possible without your fierce advocacy and fight on behalf of borrowers. But unfortunately, Navient remained a player in the private student loan space and continues to do so to this day. In fact, today it manages private student loans for more than 2.5 million borrowers.
Yeah. So in the early 2000s, Navient, which was then known as Sallie Mae, conspired with fraudulent for-profit schools to push predatory private loans onto students who Navient knew were likely to default. 39 state attorneys general later sued, and Navient agreed to cancel $1.7 billion of predatory loans. But there was a catch. The settlement only applied to borrowers who had already defaulted. So Navient got away with spending only $50 million in relief, having promised $1.7 billion, and they left tens of thousands of borrowers eating dirt. This year, I launched an investigation into Navient's failure to cancel the rest of these predatory private loans. And in response, Navient told me that it was, quote, committed to addressing valid school misconduct claims. Ms. Canchola-Banez, you work with student loan borrowers every day. So I just want to ask you, I'm going to ask you to put this one together. On a scale of 1 to 10, how would you rate Navient's cancellation process for these predatory loans so far?
I would rate it a 0, Senator.
So wait, the scale was 1 to 10 here. So you're going for 0
I'm
even so.
I'm going 0.
Okay.
Absolutely.
Explain why.
You know, we've seen the Department of Education try to streamline these types of cases for misconduct and providing relief for borrowers with federal student loans. Navient had the opportunity to create an automatic, accessible process to provide this relief for private student loan borrowers. Instead, it created a process that's incredibly complex and that everyday borrowers struggle to access.
So there's the deal, right? They could have just canceled the way they promised. Would have been easy, but they make a lot more money if they make it really hard for people to cancel. Now, just last week, in response to my investigation, Navient provided data about its cancellation process for the first time. Navient told me that it sent applications to about 4,000 borrowers, even though at least 65,000 of its borrowers attended for-profit colleges. Even more shocking, of the 1,000 applications that it has processed so far, Navient has rejected 800. In defending the predatory student loans it made, Navient's CEO said, and I quote, "Private student loans are made in good faith." Now, Professor Jimenez, You are an expert in consumer protection law. Is that a fair characterization of Navient's record on private student lending?
Not at all. Not at all, Senator. Navient knew that it was making loans to people who couldn't repay. Their CEO in 2007 is alleged to have said in court documents that he said, quote, if the borrower can create condensation on a mirror, they need to get a loan this year. They knew what they were doing. Navient now has a responsibility to discharge these loans and to do it as quickly as possible for the millions of students who are suffering.
Republican extremists want to return to the days where borrowers were just at the mercy of predatory servicers like Navient. The Biden-Harris administration has a different vision. Last week, after years of dogged work, the Consumer Financial Protection Bureau entered into an historic settlement with Navient, delivering $100 million of relief to cheated borrowers and permanently banning Navient from the federal student loan system. It is long past time for Navient to do the right thing by their countless defrauded borrowers and cancel out these loans for the private student loan borrowers as well. I want to thank you for being here, and I want to thank the chairman for holding this hearing. It's very important, and I will give you back your seat.
Thank you.
No, thank you very much, Senator Warren. Recognizing now Senator Scott,
Thank you, sir. Thank
the
you all.
newly wedded Senator Scott.
Yes, sir. Yes, sir. Extending my time beyond the 5 minutes in order to respond to the statement about me being newly married. I will say that this ring here weighs more than it appears to weigh. It's a weighted responsibility. It's a great sign, actually, because in fact, you take up the marriage process and ceremony, the wedding itself, and you come to the conclusion that it's a weighty responsibility, and I thank God Almighty that I've had the opportunity to engage in it at 58 years young. So it'll take me a little while to get to my 50th anniversary, but that's okay by me. I'll be 108 years old. Thank you so much, Senator Warnock. It's a simple concept. You take out a loan, you pay it back. I'm not sure where the confusion is on that. Frankly, I think the cost of higher education may be debatable, whether it's good or bad, but one thing is without question, the ROI on your college education is pretty darn strong in America. And frankly, the desire to see colleges move towards free, interesting concept. You look at states like Tennessee, where you can get your first 2 years of college free at their local college community schools, and those assets or those credits transfers to the four-year schools. In South Carolina, if you go to some of our local community colleges, those credits transfers to Clemson and or Carolina or to other public schools in the state. That's an easy way for states to do what I believe is a state and local responsibility, manage the resources within their states, not put that onus on the backs of the federal government. Ms. Akers, thoughts?
I tend to agree with you. The average net cost of enrollment at community college is negative based on the existing subsidies to higher education at this point. I think that, in fact, the ROI is on average very large and positive. So, in fact, people who get in and go through college and finish their degree are getting a fantastic deal. Not to say we shouldn't have safeguards for people who borrow and don't get that return, but on average, the system should work well if we were supporting it with policies that, in fact, we're buying into the idea that we would have a lending program in place.
Yeah. The low delinquency rate for private loans, less than 4% compared to over 12% for federal loans, demonstrates their effective role in managing financial risk. Do you agree with that statement? And would you?
Yeah, so part of the
Take it
problem with
goodbye.
the federal student loan program is that by design, there is no underwriting that takes place. What that means is that we have decided that we're going to make everyone eligible for the same amount of credit regardless of their prospects of being able to pay in the future. The advantages that private student loans have is that, in fact, they don't make this decision. So it's the underwriting that ensures that these loans are, in fact, affordable. We haven't done that. And if there is a predatory lender in this space, I think there's an argument to be made that it's the federal government.
Thank you. Another question for you, Ms. Akers. Wouldn't it make more sense for us to focus on comprehensive reforms like improving financial aid transparency, scaling back federal lending programs, and promoting accountability among colleges to prevent runaway tuition costs?
Yeah, so part of the problem with the federal student loan program is that by design, there is no underwriting that takes place. What that means is that we have decided that we're going to make everyone eligible for the same amount of credit regardless of their prospects of being able to pay in the future. The advantages that private student loans have is that, in fact, they don't make this decision. So it's the underwriting that ensures that these loans are, in fact, affordable. We haven't done that. And if there is a predatory lender in this space, I think there's an argument to be made that it's the federal government. Absolutely. I feel like we are at a point today where we have dissolved the functioning of the program because of all of the incremental reform. We're overdue for a reauthorization of the Higher Education Act that should basically refine, simplify the program, put in place a single lending program, tough accountability standards on colleges, maybe even an expansion of the Pell Grant program, but basically reinvest in this idea that people are borrowing to be able to make investments in themselves that they can pay back to taxpayers in the future.
One of the, I think it was 2010, when Congress passed legislation that capped a borrower on the public student loans at 10% of their income, based on that 10% cap plus I think it was a 15-year or 20-year ultimate repayment window. The fact of the matter is that already in existence is a system where the average borrower will likely not pay back what they've borrowed. That unpaid balance doesn't just disappear like magic. It actually goes on the backs and the shoulders of other folks.
In fact, I think it's a misnomer to talk about student loan forgiveness or student loan cancellation. In fact, we should be using the terminology that this is a transfer of debt to taxpayers who are now on the hook to pay for these unpaid balances.
The way I look at it, and I've said this several times, that I'm the first college graduate in my family, and I thank God that I've had the opportunity to go to college and to graduate. Think about the whole student loan debacle brought to us by the Biden administration of recent, trying to cancel $1 trillion worth of student loan debt. The one thing I keep asking myself, why is it okay for my mother, who never made more than $20 an hour, to be responsible to carry a part of the burden for people who make six figures annual salaries? I don't understand the fundamental unfairness of transferring to someone something they never signed for and transferring away from someone that they actually signed up for.
I think that's absolutely the case, and probably my fellow witnesses here at the table would be quick to point out that not everybody who's gone to college is in fact in that position of financial privilege, but it's worth revisiting what you just put on the table, that in fact there were existing programs that ensured that anybody who had a student loan 10 years ago that was unaffordable to them did not have to repay it. So in fact, there was fairness in the previous system. I would argue and agree with you today that we are moving away from fairness.
Thank you.
Thank you, Senator Scott. I think I'd like to push further on this question about repayment, bankruptcy, and related issues. Congress wrote U.S. bankruptcy law in part to help people get a fresh start from loans and other financial obligations when borrowers cannot pay. Declaring bankruptcy is not an option undertaken lightly, and it does come with lasting consequences like the ability to access credit in the future. Professor Jimenez, you've written extensively about the 2005 federal bankruptcy law that generally blocks people with student loans from discharging these debts in the normal bankruptcy process. Can you help us understand what Congress was thinking when it chose to strip bankruptcy rights away from people with student loans almost 20 years ago?
Yes, thank you. The alleged concern, as much as you can find on the record, was that students would get loans, graduate, and then file bankruptcy as quickly as possible. This was a boogeyman that was not based on facts at all. There has never been any evidence of widespread abuse by student debtors in bankruptcy, ever. Any individual cases that have been pointed out to were actually found because the bankruptcy judges threw out the bankruptcy. That's the system working as it should. Student loans do not need special protection in bankruptcy. And at the time the provision was added, banks promised they would bring down the cost of student loans for everyone. I wrote 2 papers, as you mentioned, about this with economists at the CFPB, and we found that this just wasn't true. Students didn't save any money at all on the cost of private student loans, and banks just took the windfall and moved on.
So thank you so much. I think that adds color and insight to this conversation. And it's particularly concerning when you think that it didn't save anything for borrowers in general. But it's particularly concerning with private student loans because it's not like taxpayers are on the hook for these debts and they're not repaid. Mm-hmm. So with all due respect to my colleague, it's in the case of private student loans, it's not his mother who would be taking on this debt. This 2005 provision was simply Congress doing the bidding of rich lenders rather than centering students. In the decades since CFPB released its 2012 report on private student loans, has there been any effort to restore bankruptcy rights for these borrowers?
There have been a couple bills. I think I testified at a hearing for one 5 years ago, but that's as far as we've gone.
Thank you. I believe it's time for Congress to repeal this harmful 2005 provision, and I'd welcome my Republican colleagues to join us in this effort. I know my colleagues, Senators Durbin and Warren, have been working on this issue for years, and I look forward to sponsoring and working with them to pass legislation to repeal this harmful provision. It's past time. Study after study has shown that students of color, especially black students, disproportionately borrow more often to pay for college, have to borrow larger amounts, and have a harder time repaying their loans due to institutional disparities in wealth. A 2021 report from the Center for American Progress found white households with high school degrees, white households with high school diplomas have $150,000 more in wealth on average than black households with a college degree. Routinely in this committee, I highlight generational wealth through home ownership. However, there is more to building wealth than owning a home, especially if you're too deep in student debt to buy the home in the first place. Professor Jimenez, who is most likely to be harmed by abusive practices from student loan servicers or misleading or opaque marketing language from private student loan lenders?
It's absolutely the people who needed to borrow to go to school. And they needed to borrow because we decided that borrowing is the way that we will fund, invest in higher education in this country. At the same time that we essentially require, the labor market requires people to go to college in order to get ahead. And those people are much more likely to be black, brown, and also female.
So is it fair to say that these abusive practices actually widen the racial wealth gap?
Absolutely, absolutely. And what's been proposed here by my colleague, Dr. Akers, would only ensure that this continues. If the federal government moves away from funding higher education, which it could do by loans like it's doing now, or it can do in a different way, as in actually directly investing grants. If we leave it up to the private market, then the loans will be given, if they are given at all, with bad terms to the people who come from disadvantaged backgrounds.
Thank you so much. And again, as first-generation college student and college graduate, I'm wondering how a private lender would have assessed my risk and ability to pay. With that, I turn to Senator Cortez Masto.
Thank you, and thank you to the chairman and ranking member for having this hearing. I appreciate the comments so far from the panelists. I'm curious, do you all agree with the fact that there is happening right now harmful and predatory practices in the private student loan market? Do you all agree with that? In the private market? Yes? Does anybody disagree with that? Okay. I agree with that as well. And as somebody who was a former attorney general, I saw it. And you just have to go into your state and talk to so many people that see the harmful practices. Now, with that said, is there room improvement in the federal loan process? Absolutely. I agree with that as well. One thing I want to talk about, though, and I do think there is a need for a federal student loans as well, and one of them is the Public Service Loan Forgiveness Program. There are benefits to the Public Service Loan Forgiveness Program. One of them is what the ranking member talked about when she talked about the lack of some veterinarians in rural communities. How do we get them? How do we incentivize them to go to these rural? I know in my rural communities, a lot of lack of professionals, healthcare professionals as well. One way to incentivize is student loan forgiveness. And I think it does work. What I'm curious about, however, and I know for the Public Service Loan Forgiveness Program, after 10 years of dedicated service, public service, it could be you're in a rural community giving public service, or you're in an urban area firefighter, you're a healthcare worker, you're a military member, right? There is an opportunity to get that service if you work 10 years, that loan forgiven. However, if you are doing a public service job and you have a student loan from the private market, that cannot be forgiven. Isn't that correct, Ms. Canchuela-Banez?
That is correct, Senator.
And is there concern about the transparency of that? Do you think students understand that? Do you think individuals, when they're going in obtaining these loans, is there enough transparency that they understand the distinction between the two?
There certainly is not enough transparency, and we saw this very prominently when the Biden-Harris administration announced its PSLF waiver back in 2021. SBPC heard from numerous borrowers just completely shocked, floored that their private student loans did not qualify for PSLF. And it was life-changing for them. Maybe they had taken on this loan under the assumption that it would qualify for PSLF or were given some misinformation. In fact, there is a federal lawsuit currently that alleges that call center representatives at the student loan servicing giant Mohila were actively steering federal student loan borrowers into refinancing with a private company by the name of Laurel Road. This company conveniently works with Mohila to service those refinanced loans as well. And the plaintiff in this lawsuit was a public service worker who ultimately lost eligibility for PSLF by refinancing. She was misled to believe that her eligibility would remain. She didn't figure it out until it was too late, and she lost her complete pathway to relief for her student loans.
Perfect example, harmful predatory practices in the private sector, correct? Let me jump to another area that I think is just as important. And Ms. Jimenez, let me talk to you about it. In order to understand the impact private education loan lenders are having on our students, we have to understand the scope of the marketplace. And I know you have a lot of data there. Can you elaborate on the transparency or lack thereof in the private student loan marketplace? And what data are we missing? What do we need to know to help to shed light on this and bring this transparency and education to individuals?
We need a lot. We need a lot. In 2012, the CFPB did a report on private student loans, and that's the last time we had a comprehensive look at the industry. And it has changed a lot since then. So over 12 years, we have estimates, 133, 134, 94 different $1 billion estimates of the market. And it also depends on what you define as a private student loan. We've been talking about shadow student debt. Those numbers, those shadow student loans are not counted when we're talking about the delinquency rates, the low delinquency rates that have been quoted. So we need a lot more information than we have now, just to really even understand what we're looking at.
Well, and it's true. In the school year 2022, over $10 billion in private student loans were out there for students. $10 billion, $10 billion industry. And we know whenever there's money involved, there's going to be some sort of harmful or predatory activity happening. I appreciate the conversation. One final thing to our incredible chairman. One thing I want to highlight is, unfortunately, it seems to be that our military are always the targets because of the benefits that they get. And they seem to be at the top of the list of those that want to prey on them. One of the things that Senator Moran and I have done is to introduce a piece of legislation called the Ensuring Military Access to Higher Education Benefits Act of 2024, which automatically would enroll former and current service members in PSLF, so they are not taken advantage of for the very reasons that Ms. Canchuela-Banez talked about. I would welcome all of my colleagues to join both Senator Moran and I on that piece of legislation. Thank you again.
No, thank you so very much, Ms. Cortez Masto. And Georgia's a big military state, so I share your concern in that regard. Much of what we've covered today has focused on the need for greater transparency. And so let me just ask the question directly as we prepare to close. I'll start with Ms. Banez. What sort of data would be helpful for Congress, regulators, and the public to have in order to get the clearest picture of the state of the market and to properly hold lenders accountable? We could close with that question to you.
Of course. We need comprehensive data. So that spans bank lenders, non-bank lenders, new entrants, across a multitude of origination, long-term outcomes, as well as debt collection practices, to really be able to do this apples-to-apples comparison that borrowers, that advocates, that policymakers really need in order to spot harmful trends in real time. I would also suggest that Congress consider legislating a national education debt registry, as my colleague Dr. Jimenez had mentioned before, so that we can capture everybody who is operating in this space and be able to really track and protect borrowers in the way that we need to be doing.
Well, thank you so very much. We could say so much, but we're out of time. So with that, all questioning has concluded. Thank you for all of our witnesses for being with us today. Thank you again to Senator Lummis for filling in, and Senator Tillis sends his regrets. Today's hearing brought light to the ongoing risks and the harms of private student loans and student loan servicing. What did we learn today? We learned that it's clear we need more data to understand how to better protect borrowers in the private student lending market. We learned that Congress needs to pay more attention to what is going on. And I hope we don't have to wait another decade for the next committee hearing on this critically important issue. And we have learned that the CFPB, under the Biden-Harris administration, has been and should continue to be a hero in this story. It has, under the leadership of Director Chopra, enforced the law and protected borrowers. I hope the CFPB can continue doing this great work in the next administration after President Biden leaves office. But this committee has a responsibility to ensure the Bureau has the tools and the personnel it needs to continue its work to protect borrowers, no matter who is elected in November. The hearing also helped center a focus on the current harms that student loan servicers continue to inflict on borrowers. I hope the CFPB's latest announcement, borrowing Navient from servicing federal student loans, and today's hearing send a clear message to other servicers. You cannot deceive, mislead, or otherwise abuse student loan borrowers without serious consequences. For senators who wish to submit questions for the record, those questions are due 1 week from today. For our witnesses, you will have 45 days to respond to any questions. Again, thank you, everybody. And with that, this hearing is adjourned.